Great. Hello, everyone. My name is Janice, and I am the director of the Low Income Taxpayer Clinic here at Maryland Volunteer Lawyer Service. And I want to thank you all for joining us today. We have a really great topic, a very pertinent topic, especially as we near tax day on the 15th. So I'm eager to hear all about this. So just a couple of things in general. I do want to invite everyone to join us on social media. These are great resources for information. Heather, if you move to the next slide, please.
Okay, hold on.
Great. Okay. So for those of you who are not volunteers, we certainly are always looking for volunteers to assist our clients who are in need of assistance. To look for a case, you would go to our pro bono portal, which is available 24/7. So if in the middle of the night you feel the urge to help a client, you can go to the pro bono portal to see what cases are available. Next slide, please, Heather. Great, and this is what it looks like. So our cases are put into, there are different categories of our cases. The little blue tab is tax. So for anyone interested in a tax controversy case, you would click on that, and then you could see what cases we have currently available. And we always have cases available. So please assist if you are able to. Next slide, please. And if you are not a volunteer, we do encourage you to sign up to be a volunteer. Not only do you get access to great webinars like this one, but also all of our other trainings, as well as networking opportunities and other benefits as well. So please join us. And with that, I am going to turn things over soon to Heather. But before I do that, let me just remind everyone that if you do have any questions, please go ahead and put them into the question box throughout the webinar. We will probably hold the questions till the end just so we don't disrupt Heather's presentation, but please feel free to write them in as we go along so that you don't forget them. So, and finally, Heather has been very kindly agreed to let us record and post this webinar once it's over. And those will be available to our volunteers. So if you're interested in accessing this again later, just reach out to me and I'm happy to share them with you if you're a volunteer. So, and with that, I am going to let Heather take over. So welcome, Heather. Thanks so much for joining us today.
Thank you so much for having me. This is my very first time teaching a webinar, so please forgive me if I am a little clunky or if the audio is off, but anyways, let's jump right into it. So a really important topic, I think, is representing non-filers. These are people who have not filed returns for several years, whether they're required to file or not, because they can very quickly end up with large tax issues, or they can just be victims of identity theft. They can, as we see right now, they can miss out on getting the stimulus payment. So it's very important when someone comes into your firm or your clinic who hasn't filed in a long time to really think about, should they file? Would it benefit them to file? Are they required to file? And what do we do next? So a little bit about myself. My name is Heather Posey. I am an enrolled agent, and an enrolled agent is a designation given by the IRS. It is someone who has unlimited representation rights before the IRS. So it's the same as a CPA or an attorney in regards to Circular 230. You just have to take a few examinations. You have continuing education requirements throughout, similar to other Circular 230 practitioners. I have been doing tax preparation and representation for about 8 years now. I work at a firm called JRJ Income Tax Service down in Southern Maryland in Waldorf, and I'm really passionate about what we do here. I absolutely love it, and I'm very happy to share that passion with everyone.
So I do want to jump in here. Heather is very modest, but she is one of our stellar volunteers and has jumped in to help many of our non-filer clients who need assistance with obtaining the stimulus checks. So I do want to thank her here. I also want to share that Heather is a member of the CAN group, Community Advocacy Network, of young volunteers for MVLS, and she was actually volunteer of the month for the CAN Volunteer of the Month a few months ago. So we are very lucky to have Heather join us, and we love her enthusiasm and her passion for helping our clients. So thank you, Heather.
Oh, thank you, Janice. Okay, so today we're going to talk about those who have a filing requirement, those who don't necessarily have a filing requirement but should probably file anyways because it would be to their benefit, the initial steps that you should take when you have client intake, when they have a lot of years that have not been filed, how you go about filing those returns, recreating any records that need to be done, getting a hold of wage and income information and deduction information, the IRS Statute of Limitations as regards to collections and getting refunds, and how you can go about planning the best resolution for each specific client. So the word non-filer was really brought to the forefront of our vocabulary with the economic impact payment because, of course, they had the non-filer portal, which was for people who did not file, not people who were not required to file, or sorry, vice versa. But it really became a new word, like non-filers as people who do not file because they are not required to file, instead of just historically where it had been people who haven't filed for a long time but should have. So these individuals, non-filers, are people who do not have a filing requirement. Maybe they just get Social Security or VA disability, or they get Social Security disability or other like long-term disability that's not taxable. People who are in school and are not working, they don't really have taxable income, or just other people who really have no taxable income or their taxable income is below certain thresholds. So those who are required to file, if their adjusted gross income, of course, is more than the standard deduction for their filing status, their age, and that specific tax year, or if they have self-employment income over $400. This is something that gets people mixed up often because, of course, their self-employment income is it can be less than the standard deduction, but when your self-employment income is over $400, that is when you have to pay self-employment tax. So whereas you may not have any income tax, you will still have self-employment tax. And there's the same concept when you take an early withdrawal from a retirement plan. You can still be under the filing requirement in terms of AGI. You won't have to pay any income taxes. However, because you took that withdrawal early, you have to pay that 10% penalty. So you will be filing just to say that there's a 10% penalty, basically, and be liable for that penalty. Now, if someone has income that's non-taxable at the federal level, but it is taxable at the state level, like in an example would be municipal bonds or some like tax-free bonds, they can be tax-free to federal, but still taxable to state if they are not that state's municipal bonds. And then if you have foreign earned income, you of course should file to claim the foreign earned income exclusion, or you may have income over that exclusion, and some states do not recognize the foreign earned income exclusion. So there are a lot of situations where someone's AGI would say that they shouldn't file, but they need to file. They're required to still. And then there are people who are not required to file, but would be better off if they did file. So that it, of course, is going to be people who had taxes withheld from their wages or pension income that could be refunded to them, people who are eligible to claim refundable tax credits, such as the Earned Income Tax Credit, the Child Tax Credit and Additional Child Tax Credit, or the American Opportunity Tax Credit. So even if their income is well below these filing thresholds, they should still file because they could get quite a bit of money back. So it's in their best interest to file returns timely. Now, if someone had a cancellation of debt, then they need to file because they need to report that election on their return to exclude it from their income. So if it's a foreclosure from their home, and of course it's principal residence indebtedness, it's not taxable, but you still have to file a return to tell the IRS, I had this foreclosure, there was cancellation of debt income, but it's not taxable to me. Or if someone sold their primary residence and they need to report that exclusion from their income, because otherwise the IRS is going to think that they need to file a return because they're just going to see the wage and income transcripts. They'll see a 1099-S for a sale of real estate for however much money, and then the IRS is going to say, hey, you need to file a return for this. So if there is a sale of a primary residence, just always do a return. And then there are the delinquent filers. These are the people that have tax issues. These are the people that you're going to see most often, I believe, because these are the people that their non-filing has created assessments already by the IRS, or if the MVA has put a hold on their driver's license or their vehicle registration because of non-filing, or if they have a professional license with a DLLR that they cannot renew. These are people who, you know, the taxing authorities start to put the pressure on them and they come into your office. Or it can be someone who needs to obtain a government clearance and cannot obtain one because they have many years of unfiled returns or they have unpaid balances. So when you first meet with a non-filer, you, of course, want to talk about, well, why didn't you file? What was going on? Because they're going to tell you, well, I got audited one year and I was too scared to file again, or I was told that I didn't have to file, or it could be something a little bit more, I would say reasonable. Not reasonable, but, you know, something more dire. Like there were health concerns, there was a death in the family, or someone was seriously ill, there was a fire, so a lot of their records were destroyed, things like that, because those types of situations you can use to your advantage or to your client's advantage, because you can tell their story to get any penalties abated later on. Because, of course, there's a failure to file penalty, failure to pay, all that such. But if they have a reasonable cause for not filing these returns, then the penalties can be waived by the IRS. So it's very important to just talk to the client and hear them out and just really be sympathetic to their story. So the first thing that you're going to do when you are formally engaging with the client is you're going to want to get either an 8821 or a 2848 so that you can pull their wage and income transcripts and their account transcripts, because that is going to tell you exactly how this engagement is going to go. When you pull their transcripts, you can see if there were substitute for returns done by the IRS already, if returns were filed for them already and maybe they forgot, if returns were filed and it was identity theft. And then you can look at the wage and income transcripts and see where their income came from that year, because a lot of times with many years to file, clients don't have all of their records anymore. So those IRS transcripts are going to be your roadmap. So, of course, like I mentioned, you want to check the account transcripts for substitute for returns. This is what I do almost immediately with every multi-year non-filer client, because if the IRS has already done a substitute for return, the engagement really changes course from just normal filing to filing to see if the IRS's assessment is correct or if it's incorrect, if there were deductions that were missed, things of that nature. So the IRS has a 6-year rule for collections compliance. So this basically means they want you to file the last 6 years to be considered in compliance for collections purposes. And this is going to be when you are setting up an installment agreement, when you are doing an offer in compromise, things of that nature. The IRS only wants to see the last 6 years. Now, of course, the client is legally required to file every year, but you kind of want to balance doing just the last 6 years against doing every single year, because it depends on where this engagement is headed, and we'll talk about that a little bit more later on. But just keep that in the back of your head, that the IRS just wants the last 6 years as a rule. Now, again, this is only the IRS. The state of Maryland wants every year, and other states are going to have their own rules for how many years they want. Okay, so substitute for returns. This is what it's going to look like on an account transcript. Instead of saying something like tax return filed, it's going to say substitute tax return prepared by IRS. And this is your indication that, okay, things are going to go a lot differently for this year. So when the IRS prepares a substitute for return, it is basically a worst case scenario. They just take whatever income there is. There are no deductions, no dependents. The filing status is either single or married filing separately. You take the standard deduction. There are no elections, no preferential tax treatment for anything. It's just bare bones. This is what you made. This is the tax on it. So it's always a good idea to look at possibly filing a return for that year, because it's very probable that whatever assessment you can come up with on a tax return is going to be a lot better than what the IRS came up with. And the state of Maryland normally follows a federal SFR, or sometimes they will do their own SFR based on the wage information that they have between their wage and income transcripts and the federal's wage and income transcripts. So when you are going to file a return in replacement of a federal SFR, you can't just do the return and mail it in as a normal return or e-file it if it's a recent year. You have to send the return to the address of whichever IRS campus made the substitute for return assessment. And it is considered an SFR reconsideration. So you are going to be sending it to that address where they will adjust the account accordingly. What I always do is, because it's going to be a different campus a lot of the time, so I call practitioner priority services and I just say, there was an SFR done on this year. We need to send in a reconsideration. What campus did it, or what address should I send it to? And they will give me that address. For Maryland clients, I've noticed that it is often the Brookhaven, New York campus, but I still always call PPS no matter what. The state of Maryland, if you are doing a reconsideration for an SFR that Maryland has done, you can just send in the tax return as normal. They will process it just like a normal return. So one of the biggest obstacles with non-filer clients is obtaining the prior year's records, just having to reconstruct everything for that year income-wise and deduction-wise. It can be very, very difficult because not everybody keeps stringent records, especially for multiple years. So the first thing I go by, of course, is the federal wage and income transcripts. Now, that's only going to show federal withholdings or anything that was reported to the IRS. So a lot of times I have to supplement it with state withholding transcripts. So Maryland they're pretty good with their wage and income transcripts. Sometimes it's a little spotty. There will be some things that are on the Maryland that aren't on the federal. That's rare, but it's more often there are things that are on the federal but are not on the Maryland, especially when maybe an employer is not Maryland-based. They might not send a copy of the W-2s to Maryland as they should. So in those situations, you could try to get a last pay stub if possible. A lot of times it's not. So something else you can do is you can request copies of the W-2s from the Social Security Administration. It costs $81, so it's not always the best thing to do. But if this client probably had a lot withheld for the state, it could save them a lot of money. So it could be worth it. If you're going through the transcripts, you can maybe see what jobs they worked at and have the taxpayer contact those employers if they're still in business and try to get copies of those W-2s. Of course, it doesn't always work. Maybe they left on bad terms, or that business has closed or changed names by now and the taxpayer doesn't have any contact information. But it's still an avenue that I always try to use. For deductions, you can, of course, get someone's property taxes online. You can get their bills from most counties and figure out what they paid, so you can use that for either your itemized deductions, for office and home, or anything else. And then for taxpayers who were self-employed, if they did not keep decent records of their business expenses, something that I rely on pretty often is the Kohan Rule. So the Kohan Rule came about in a pretty famous tax court case, Kohan versus Commissioner, and the court basically said that the court can estimate the amount of an expense if the taxpayer is able to demonstrate that he has paid or incurred a deductible expense, but can't substantiate the precise amount as long as he produces credible evidence, providing a basis for the court to do so. So if a client has some records, like some of their bank statements, a couple receipts, if they're able to go to some of their vendors that they normally shop with, like Restaurant Depot, if they are in the food industry, or maybe 84 Lumber, if they're in construction or something of that nature, and get some back receipts, then that can be a starting point. Or if they use Amazon to buy business supplies, then they can go through their Amazon account. Just something that shows that there were expenses incurred, and while they don't have all the receipts, you can provide a reasonable estimation of what they possibly spent, and it's something that can hold up in court. Now, you can't go crazy with it. You can't use it for travel expenses. You cannot use it for meals, entertainment, which isn't really relevant these days, or gifts. So any expenses that are talked about in Code Section 274, you can't use it on that. But other expenses like supplies and office expenses and insurance, things of that nature, you can use it for those. When it comes to mileage, taking the mileage deduction, you can recreate mileage logs. Of course, the taxpayer should be reasonable with their estimates. And these are things that can be substantiated using vehicle maintenance records. if they have any records from oil changes that they got, or when they took their car into the shop and the mechanics notated the odometer reading, if the taxpayers kept a calendar of when they had business meetings or when they had to do certain jobs, if they have email records, emailing back and forth with clients to set up meetings or jobs, then these are things that we can use to substantiate the fact that business miles basically were driven and that these are deductible expenses. So when it comes to the statute of limitations for refunds, the general rule is that the refunds are available within 3 years of the return's due date or 2 years from the time the tax is paid, whichever is later. So normally, like right now, we can get refunds for 2019, 2018, and 2017 tax returns. We normally cannot get refunds for 2016 returns, although there are certainly some special exceptions. And then 2 years from the time the tax is paid, so if the taxpayer owed money with a return and they made a payment and you later on decide that this could be amended, then you have 2 years to amend the return and get that payment back. Or also if there's an SFR and the taxpayer either makes a voluntary payment, if they have future refunds intercepted, if wages or bank accounts are levied, basically anytime a payment is made towards that account, you have 2 years to get it back, no matter what year, no matter what tax year the payment was for. Now, the rules regarding the refund statute expiration dates, it's Code Section 6511, they can be very, very complex. This is something that would be a webinar all in itself. So if you are unsure whether your taxpayer situation warrants a refund, I think that your best bet is to still file the claim for refund, and then if it's rejected, you can appeal it using citations from the relevant law or anything of that nature that you discover after the return has been filed. Because the IRS computers, they cannot accurately calculate every situation in which a refund is lawfully due to a taxpayer. So it's in your client's best interest for you to really bone up on Code Section 6511 and to just file claims anyways. And if they get rejected and your research finds later that they weren't eligible for that refund, oh well, you still tried. But if they were, then you can go forward with that or appeal a rejection. So the collection statute of expiration, definitely a little similar.
Heather, before you move on to that, quick question about the refund statute of the RSED. So, for example, this year, where the return due date was moved to July, is that considered the return due date, or does it still go by the original April 15th due date? How would this work like 3 years from now?
So
this is an area of question.
Yes, it definitely is. It definitely is.
So that's really not clear then whether we could use the July as the return.
It's right. I mean, I'm
at that time.
Yeah, I want to say that it was April 15th was the deadline for 2016's, but I know that notice, notice 2020, I think -23 or something like that, it extended all due dates that were after April 1st. So I think that could be cited as to
for the 3 years, okay.
Getting a refund after, yeah.
And then what about going forward then, like 3 years from now? Do you think that they would be using the April date or the July date then? Or
I
maybe
think
a
they're going to use
question
the
for
April date.
3 years from now?
It's definitely a question for 3 years from now. I think that they would likely issue some guidance on that, because I'm sure that's a question that a lot of people are going to have. But my knee-jerk reaction is to say they are still going to stick to the April 15th date.
Okay.
This was more of an administrative thing for the IRS to just push the date that they're going to accept a return and have it be considered timely. But the actual return due date is statutory. It's set in stone. So I believe that it's going to be April 15th, but I could be wrong. I would like to be wrong. So
Okay.
I guess we'll see what they do.
Okay. And one of our listeners made a comment just to regarding the RSED, in that even though it's 3 years, there are sometimes exceptions. So where a person may be physically or financially incapacitated. So
Yes.
can you speak a little bit on that? I know it's a big topic though, so probably a topic for a whole nother webinar. Perhaps you can touch on that, because
Yeah.
that's an area where the RSED might be maybe adjustable based on that.
Yeah, it can be. It can be. When someone is considered incapacitated or financially incompetent or something of that nature, the RSED kind of, well, it tolls, basically. You can still submit a claim for refund within that time period, and oh gosh, that's something that I need to look into, like how to properly assert.
I think the bar is very high. But certainly it is something that to consider if anyone runs into a client who might fall within that category, and we can certainly discuss this perhaps in more detail in a future webinar. But it's an interesting area, but I think the bar is extremely high. It's very difficult to get someone approved for such a being financially incapacitated. So, okay, thanks. All right, sorry, we'll go back to the CSED then.
Okay. So with a CSED, it's, as a rule, of course, 10 years from the date of assessment. And an SFR is included in that. The SFR constitutes an assessment. So that starts the CSED if you file a return in reconsideration of the SFR, if you lower the assessment by any amount, it doesn't restart the CSED clock. It doesn't extend the CSED clock at all. It is basically just reducing prior tax assessed. So this is something that you want to consider with non-filers who have SFRs already. Is when the CSED starts, is when that SFR is done. Now, for clients who do not have SFRs, or there is a year where an SFR has not been done, when you file that return, that is when the CSED is going to start. So this is also a reason why you should really keep the 6-year rule in the back of your mind, because if you are filing years beyond that and the client is not able to full pay their liability, then it might not be in their best interest to file a return, because the CSED is starting after you file it. And of course, it may really hamper the client's ability to get on a partial payment installment agreement or to do an offer in compromise, because of course, when the IRS does their calculations based on how many months are left on that CSED, if there's 10 years left, it's going to kind of affect the client's chances to be able to achieve those resolutions. So this is just something to always keep in the back of your mind, and always discuss this with the client, because of course, whether they want to file a return or not is their choice, but it's something that I discuss with them, that we can do it, but the 10-year clock starts now, so it might not be the best thing for you. So after you get all of the facts, after you look at the returns that need to be done, look at how much is going to be owed on each return, if anything, that's when you can kind of decide where you're going to go with this. Now, optimally, we would love to see no deficiencies in any of the years, because that would just make the engagement very easy and you could just file all the returns and let that be that. If the deficiencies are relatively low or in a range that the client can afford and they are willing to pay it in full, that's fine. You can do that too, and then you can maybe look into penalty abatements to waive some of those failure to file, failure to pay penalties that are going to creep up after the returns are filed. You can do, of course, reasonable cause, or maybe even just a first-time penalty abatement for one of the years. Or if the client is able to afford a full pay installment agreement, then in that situation, I would still be kind of selective about what years I was going to file, because I don't want to put an undue burden on the client that we don't necessarily have to. If the client is looking more towards a partial pay installment agreement because their disposable monthly income is pretty low, or if it's going to be, if their account is going to be put in currently not collectible because of their current financial situation, again, I would be mindful with the filings, because I don't want to create too much of a liability for them, because of course if they're in CNC, then they have to recertify every few years, and maybe their income is going to get above these thresholds and they're going to be considered collectible and be on the hook for all those taxes. And of course, with a partial pay installment agreement, you want their liability to be as low as possible so that the IRS is more likely to, I mean, not more likely to accept it, of course, because it is what it is, but you still want that liability to be lower. And of course, with the offer and compromise, that one, the liability, it is what it is, and whether or not they can pay is what it is. But of course, there's those CSEDs that we don't want a 10-year CSED on debt that we're going to be submitting an offer and compromise for shortly. We, of course, want shorter CSEDs, so the IRS is a little more willing to compromise the debt. Now, if you think that the client is going to be going through bankruptcy, an SFR, an assessment that's made with an SFR, cannot be included in bankruptcy, because the return that the service does, it does not meet the Beard test. It is not signed under penalty of perjury. Therefore, that assessment cannot be included in bankruptcy. Now, any other return that you file where there's not an SFR, of course, that can be within the applicable time limits, but just know that SFRs cannot be. So just advise your clients accordingly. Now, I'm not a bankruptcy attorney, so I don't know much else. I can't say much else, but that is the most relevant part for this situation.
And I think that is extremely important. The bankruptcy rules can be very convoluted and quite complicated, and I don't always understand them. So I think it's always a good idea to refer to a bankruptcy attorney and just touch base with them and make sure that you're both working together to choose the best option for the client. So, okay, very good. All right, so Heather, I think you've come to your last slide. Perhaps you can leave that as leave that one up so we can go back to that if we need to. But we do have a quick question about this last slide. So there is a question about what is the 2-year, 3-year rule. So that is a bankruptcy rule in terms of whether or not a tax debt can be rolled into bankruptcy. And again, this is there's some complications regarding, I mean, it's sort of a complex rule. So that's why I suggest that always it's good to speak to a bankruptcy person to see if a tax debt can actually be rolled into bankruptcy. Has that been your experience, Heather, that if you find someone that if a client comes in and you're kind of wavering on, well, is this a tax issue or could it possibly be rolled into a bankruptcy, then do you consult a bankruptcy person, or how do you make that determination?
Yes, I certainly try to calculate the CSEDs or the CSEDs and the assessment dates, because that is what controls normally what controls when tax can be included. And I might look at the assessment dates just to see, but I still just send the transcripts, send return information to the bankruptcy attorney that the client is working with, and let the attorney make that final call.
Yeah. And sometimes I think especially if the client has other creditors, and if the tax situation can be resolved through bankruptcy, then sometimes it's better for the client as a whole. But if tax is their only issue, even if that tax debt might be able to be rolled into a bankruptcy, if the client doesn't have any other debts, or it's probably not a great idea for the client to simply to apply for bankruptcy simply because of the tax debt, because there are some other ramifications and consequences for applying for bankruptcy. So anyways, we do see this a lot. So someone has a question about a CNC. I think this is on your slide here.
Yes. Yeah, I'm sorry. It's right there. Currently not collectible is what that stands for. I'm sorry.
Okay. And so that's a status that is helpful for clients who are not able to make any payments. We see that a lot in my world, where clients are perhaps not earning enough income to be able to make any sort of payment to the IRS. And so putting them into a currently not collectible status is helpful. It's a way to prevent collection activity from happening on the client. It does not, unfortunately, stop the interest and penalties that accrue on the balance due. So that continues to grow. However, it does allow the client to have a little bit of a break, or a little bit of a breather from collection activities as well. And one thing that can happen is with the currently not collectible status is that people can actually sit in that status for quite a while, as long as their financial situation does not change. And I actually have had clients where we've hit the 10-year statute of limitations while they were still in the CNC, and that's been one nice way of getting rid of a debt without having to do a whole lot except waiting it out. So, but I think that is something always to know, that that's a tool that one can use. So. We do have a question, Heather, about someone who's not filed in many years, but was self-employed in, say, a sales position. Unfortunately, they never made very much, and they always ended up not meeting business expenses, including the rents. I think this is very similar, actually, to a client I just referred to, Heather, who was a self-employed individual, had not filed for many years, but and he actually had tried to use the non-filer tool because he thought he was a non-filer, but unfortunately, as a self-employed individual, he made like, what was it, $5,000 or $7,000. So he clearly exceeded the $400 mark. And so, Heather, can you describe a little bit about what you did with this client and sort of what happened with him and how you would counsel him going forward?
Yeah. So, well, he gave me his 1099s, and we are basically doing a Schedule C where he has his gross income. And then we talked about his expenses and what kind of things he might possibly have receipts for somewhere, like within his bank statements or within credit card statements. And we were able to recreate some of the expenses but his net income, of course, was still over $400, so he still was liable for some self-employment tax, and that would be the same story for every year prior, because I believe you said he hadn't filed since 2007, so that's kind of how his tax returns would look every year, would just be trying to report these expenses, trying to recreate these records to report these expenses against his income and still being liable for self-employment tax each of those years.
Right. So I think this is always a great opportunity when anyone sees a self-employed individual, is not only to help them get their back stuff taken care of, but also it's a opportunity for education for the future. It's important for clients to know that they, especially if they're self-employed, to keep records so that they can hopefully have information going forward. But then also, they may also need to be aware of paying quarterly self-employment taxes. You know, a lot of people who become self-employed don't realize that there are certain ramifications with being self-employed. And so as tax practitioners, when we run into people like this, I think it's important to help educate them going forward, as well as helping them with their current situation. In this case, for this particular client, he unfortunately ended up owing a tax for this year, but it also then allowed him to become eligible for the economic impact payment. So I think for him, then it works out better for him, even though he ends up owing a tax for last year. He then is in the system to get a payment. So I'm sure he wasn't very happy though when he found out that he owed some tax.
No, he was not.
Yeah, unfortunately. Okay. So this is another question along the same line. So this recent case of the self-employed individual, would there be a recommendation to file the returns back to 2007 just for Social Security purposes?
Yeah, that's a good question. I think it might be a good idea to prepare the returns, see what kind of tax liability there might be, and of course balancing out how old the client is, how close they are to reaching Social Security retirement age, and just to speak with the client about, okay, we can do these tax returns. This is what you would owe for these years, but this is also what's being paid into Social Security, and kind of not really let the client decide, but just speak with the client about it. Like, is this something that is going to be worth it for you?
Right.
Like, yeah.
So, and I think this again illustrates the importance of education for the client going forward. You know, clients often think of taxes as just being the income taxes that they have to pay, but they don't understand that there's the self-employment taxes like Social Security that can benefit them later on. So there may be some long-term benefit that they're not aware of, and so I think it is important to bring that up as well. And one of our listeners also mentioned the Social Security benefits for dependents. So there's actually quite a lot going on here that most people probably don't even realize why it's important to do that.
Yeah.
So it would be
or disability too. So even if they're young, but if they get hurt on the job and they haven't paid anything into Social Security, then they wouldn't be able to draw Social Security disability benefits.
Right. I do think though, also in terms of time frame, so I think someone has a question about the time frame for filing. Usually the IRS looks back about 6 or 7 years. They don't typically go back too far. Whereas I think in one of your slides, Heather, you mentioned that the state does go back forever.
Yes. Yep, the state of Maryland goes back forever. I have had the state of Maryland request returns back from the 1980s.
Wow, that's crazy. Yeah. So in that case, someone from it would be very difficult to expect someone to have records from 1980, and so in that case, then it would be helpful to recreate something if you can. So
Yeah.
So one way of recreating, you had mentioned that there were certain suggestions for recreating records. And I think if you'll go back to your slide, there was
Mhm.
one slide that showed that you could perhaps get some records from SSA, and you
Yeah.
described that it would be an $81 cost. Um, do you know, does that 81, is it like $81 per year or per W-2 or for a
So
whole bunch of years? Or
their website said that it is $81 per request.
per
I
request?
actually don't know if they break up each year into a separate request, or if you request them all at once, if it's just $81.
Okay. Okay. All right. All right. Oh, so here's a question that just came out. And I'm not sure I completely understand that. It says, is when Maryland goes back forever, is that due to an income threshold? So I think that means that so everyone, there is a filing threshold. I'm sorry, a threshold for a legal filing requirement, right? And so for people, if people are under that filing requirement, then they don't have to file, regardless of when. But if it's over that threshold, they do have to file. And so in that case, if they do have a filing requirement, Maryland does go back forever. Is that,
Hmm.
is that, does that make
Yeah,
sense?
that
Is that clear?
yes, it does, and that's basically how it's been in my experience. But I've still had Maryland say, well, they haven't filed a return for this year, and there is no wage and income information, and the client can't really get any records or anything of that nature either. So, I mean, I would love to think that it's just based off of filing requirement information, but sometimes I don't know.
Well, I
Sometimes,
think
right.
Maryland is not always very transparent in their
Right? No, they're not.
requests. Um, so that can be challenging. I think that they are trying and working towards becoming more transparent with some of their rules and regulations, but I have found that it sometimes depends on who you're speaking to at the comptroller's office, and you might get different answers. So, um, so I do find Maryland sometimes to be more challenging to work with. I don't know if you've had that
Yes,
experience, Heather.
myself.
Yeah.
Oh yeah, because with federal, everything's laid out. It's in the Internal Revenue Manual. It's in all the tax code. So it's a lot easier to know what rules everyone is following or should be following. But Maryland, like you said, is not transparent at all, so or barely transparent. So it can be very, very difficult to know where they get the information from or what the client is supposed to do, or I don't. Just sometimes it can be very difficult.
And so it's just a little bit more challenging sometimes to work with Marilyn. So definitely.
Yeah.
So very good. All right. Well, thank you. Well, I think I've gotten through most of the questions here. Let me take a quick look and see. Um, but great. If anyone has any other questions, please go ahead and write them in and we can address them. But I feel like we've gotten through a lot of information here. And, I think that certainly this terminology, like you said, Heather, came up initially with perhaps the lower income client population who didn't need to file. But I think we are running into also a lot of people who thought they were non-filers because they didn't
Yeah.
they called themselves non-filers because they didn't file, but they really weren't.
Yeah.
They shouldn't be considered non-filers because they didn't meet the definition or the criteria for being a non-filer, but they just kind of said that they were a non-filer. And so because of that, uh, we do have some clients who have actually filed or gone through the non-filer portal, and they were able to receive their stimulus checks because of that. However, if they do have a requirement to file, then they would have to go back and actually file a tax return for 2019 based on that. So, and in that case, Heather, would that have to be an amended return then? That they would, if they filed an
so
actual
what is
correct return?
so
So,
what we do, or
Uh-huh.
what should be done is, of course, because when you use the non-filer portal, what the IRS does is they just create a what they call simple return. So it's just a tax return that shows $1 of interest income, and then they use that direct deposit information and all that to send out the economic impact payment. So
Mm-hmm.
then when someone tries to file their 2019 or 2019 tax return, of course, if they e-file it, it's going to be rejected saying there's already been a tax return filed for your social. So the tax return has to be mailed in. It's not an amended, it's an original tax return. And at the very top of it, you write amended EIP return. And then the IRS uses that to basically overwrite the return information that they already have.
Okay. Okay. So, so the important thing is that it's an original return, but that you should write on the
Yeah.
top of it amended EIP return. Is that correct?
Yes.
Okay, great. Yes, I think this is a very confusing area, certainly. Um, and not something that we see frequently, which is why I think it has caused so many questions and so many issues have arisen from this. But I think it's important going forward. Everyone, of course, wanted to get their stimulus checks very quickly, and so a lot of people did go ahead and use that portal, thinking that they were non-filers. But as Heather said at the very beginning, that really has a very specific definition. So great. Well, thank you, Heather. Thank you for going over this and also exploring some other avenues and other topics
Very well.
that were all related to this. So again, everyone, Heather has very generously agreed to let us post these slides as well as her recording of this. So if you are interested in reviewing this, let me know. You can email me at jshih@mblslaw.org. And we will get them to you, to our volunteers. So thank you, Heather, and we'll see everyone again next month. Stay safe, everyone. Take care. Bye-bye.
Bye, everyone.